Shanghai silver held a $12 premium through an 8% Western dump. Qatar just halted LNG production. 20% of global gas supply offline. European gas prices spiked 52%. And while all of that happened, Western silver got slammed from $97 to $90 in under 2 hours right before New York opened. Physical demand in the East didn't blink. Paper price in the West collapsed. That divergence is the entire story. I'm Roxanne, and what you're watching is the physical precious metals market completely decoupling from paper futures in real time. Roxanne here, and as you know, I bring to you raw data, verified sources, zero BS. Let's start with what happened Monday morning, because the sequence matters. Silver gapped from $93 Friday close to nearly $97 at the Asian Open. Gold punched above $5,400. The premium told you before the Western markets opened. Kinesis silver was trading near $100 over the weekend. Hyperliquid at $96. Physical-backed crypto markets running all weekend, providing real-time price discovery while COMEX was dark. That gap was your preview. But here's where today becomes critical. Silver is now sitting at $90. Gold at $5,346. And the path that got us here, the reversal, the divergence, the forces that created it, that's what matters. Because what played out isn't just a price move. It's a masterclass in understanding how physical reality and paper markets are separating. Start in China. While American traders were waiting for New York to open, China was already in a full-scale physical gold buying frenzy. China's largest e-commerce platform adjusted its gold pricing to the equivalent of $5,574 per ounce Monday morning. Western spot was sitting at $5,346. That's already a massive gap. But then something happened that reframed even that premium. Physical supply started running out. Major physical gold retail stores across China stopped selling investment gold bars entirely. Not slowed down, stopped. The only gold available for purchase at those locations right now is craft gold, decorative pieces, jewelry-style bars, not the investment-grade products that Chinese savers have been piling into for months. And the price on those craft bars? The equivalent of $6,329 per ounce. Let that number sit. $6,329. Western spot is at $5,346. That is roughly a $1,000 premium on physical gold in Chinese retail stores. Not because of pricing algorithms, not because of currency conversion quirks, but because investment bars are gone, sold out, physically unavailable. The shelves are empty. This is not a technical divergence on a chart. This is physical scarcity materializing in real time in the world's single largest gold-consuming nation. And then the platform itself gave out. Jingdong Finance, running gold accumulation products in partnership with Guoguang Bank through China's largest e-commerce platform, crashed Monday morning. Severe congestion. Users unable to log in, unable to purchase. The infrastructure buckled. China holds 336 trillion yuan in domestic savings. A meaningful portion of that capital tried to move simultaneously into gold at the open, and the systems built to handle it were simply not designed for what happened. Every major Chinese bank reporting a gold buying rush. Every Chinese gold miner hitting the daily limit up. This is not quiet institutional accumulation. This is a stampede. And here's the detail that should make every Western investor stop and pay attention. Chinese miners are limit up. Western miners are not following. If you've been watching precious metals markets for any meaningful period, you know that historically miners amplify the move in the underlying metal, sometimes by a factor of 3 to 5 times on a percentage basis. That divergence between Eastern and Western mining stocks right now is either one of the most significant near-term opportunities in this sector, or it's a warning signal that institutional money in Western markets is not yet convinced the breakout is real. Now zoom out to the energy picture, because none of what's happening in precious metals makes sense without understanding what's happening to global energy infrastructure simultaneously. Iran has struck 15 different countries or military installations. Count them: Israel, the United States, UAE, Saudi Arabia, Qatar, Kuwait, Jordan, Iraq, Bahrain, Oman, Syria, Cyprus, plus French, Italian, and British military positions. 15. This is not a contained regional skirmish. This is a multi-front military engagement targeting the most critical energy infrastructure on the planet. Qatar just halted LNG production. QatarEnergy announced Monday it ceased production of liquefied natural gas and associated products due to military attacks on its operating facilities in Ras Laffan Industrial City and Masayid Industrial City. Qatar's defense ministry confirmed 2 Iranian drones targeted the sites. One hit an energy facility in Ras Laffan, 80 kilometers north of Doha. The other struck a water tank at a power plant in Masayid, 40 kilometers south of the capital. This is massive. Ras Laffan hosts Qatar's 77 million ton per year LNG export terminal, the world's largest. Qatar accounts for roughly 20% of global liquefied natural gas supply. 1/5 of the world's LNG just went offline. European natural gas prices exploded. Benchmark Dutch TTF natural gas futures climbed 49% in a single day to 47.65 euros per megawatt hour. UK natural gas futures rose 45.6% to 113.44 pence per therm. This is the largest one-day gas price move since Russia invaded Ukraine in 2022. Asian LNG benchmark prices. The S&P Global Energy Japan-Korea marker jumped 39%. China, Japan, and South Korea are Qatar's largest LNG buyers. India imported roughly 11.3 million tons from Qatar in 2024, according to World Bank data. All of those buyers now face potential shortfalls and will turn to the spot market, driving prices higher. US and Australian capacity is already tight. There's no quick replacement. Goldman Sachs warned that a 1-month closure of the Strait of Hormuz could push European gas prices towards 74 euros per megawatt hour. A disruption lasting longer than 2 months could send prices above 100 euros per megawatt hour. Anne-Sophie Corbeau from Columbia University's Center on Global Energy Policy said, if sustained for weeks, you're going to see an impact on gas prices, heating bills, and electricity bills across Europe. At the same time, Saudi Arabia's Ras Tanura refinery, processing 550,000 barrels of crude per day, halted operations following an Iranian drone strike. That's Saudi Arabia's largest refinery. A source close to the Saudi government warned that a concerted Iranian attack on oil facilities could trigger a military response. Saudi Arabia would target Iranian oil facilities if Iran mounts a concerted attack on Aramco, the source told AFP. So you have Qatar's LNG production halted, Saudi Arabia's largest refinery offline, the Strait of Hormuz functionally frozen, 15 countries engaged simultaneously. And the US president stated publicly, "We haven't even started. The big one is coming soon." By any traditional reading of markets, by any framework connecting supply disruption to price discovery, oil should be spiking to levels we haven't seen in years. And here's where today delivers its most uncomfortable data point. 30% of global oil supply is effectively offline or frozen right now. And oil is going down. Oil gapped higher 8 to 9% at the open to over $82 and is now fading. It drifted from $73 all the way down to $70. Something is working very hard to hold that number down, despite everything physically happening in the world. This is paper markets suppressing physical reality. We saw it in silver's weekend premiums running 7 to 8 points above Western spot while COMEX was dark. We're seeing it in oil's price suppression despite a catastrophic simultaneous supply shock across multiple producing nations. We're seeing it in Chinese physical gold stores literally running out of investment bars while Western spot prints $5,346. The distance between these two versions of reality, the paper version and the physical version, is the single most important variable in precious metals right now. Because the history of that gap is not that paper wins. The history of that gap is that paper eventually gets dragged toward physical. The question is timing. Now let's get into specifically what happened to silver Monday morning, because gold and silver diverged dramatically at the New York Open. Gold is up on the day. Silver got slammed. At the New York Open, silver was pushed below $90 aggressively before the full session even started. There are two explanations, and both deserve honest treatment. The textbook explanation first. This is a supply shock event, not a demand boom. A sudden catastrophic supply disruption creates a growth scare. When growth fear is the dominant regime, industrial metals take the hit. Silver carries approximately 50 to 60% of its total demand from industrial applications. Solar panels, electric vehicles, electronics, artificial intelligence infrastructure, defense manufacturing. When the market suddenly prices in the possibility that global energy disruption of this scale will hit industrial output projections, it hits silver's demand story directly. Gold does not have that problem. Gold is purely monetary. No factory requires it to operate. No panel needs it to generate power. In this regime, gold leads and silver lags. The order is always the same. Gold first, then silver, then platinum, then copper. The more industrial the metal, the harder it struggles until growth uncertainty clears. But a 7 to 8% dump from highs in under 2 hours, concentrated right before the New York Open, is not purely textbook. When silver closed at $94 last session, sentiment across this space went vertical. Everyone was calling for a straight line to $100. Maximum bullish crowding at exactly the wrong point. What we saw Monday morning is the exact mechanism. A flush sharp enough to shake out every late entry, reset retail conviction, and leave the people who came in expecting a straight line to all-time highs wondering what went wrong. Here's what you should be watching right now. Pull up the hourly silver chart. Add the 150 exponential moving average. When silver got slammed to $88 at the New York Open, that is exactly where it found support, right on that level. It has since bounced back to $90. That level is critical. If silver loses the 150 EMA on the hourly and fails to reclaim it, the next target is $84.9, possibly lower. But here's what the premium data says right now. Shanghai spot silver is sitting at $102, Western spot at $90. That is a $12 premium still intact even after the Western Open slam. Shanghai futures at $105. The premium survived the New York attack. When Western paper price goes down and the Eastern premium holds its level, it means physical demand in Asia has not responded to the paper price move at all. The buyers in Shanghai did not look at Western spot and decide to reduce their bids. The premium between East and West stayed roughly stable through the entire 8% dump. That tells you something important about where the real conviction sits in this market right now, and it does not sit in New York. Let me give you the context on Shanghai premiums because this is critical. The Shanghai Gold Exchange requires physical delivery. Unlike COMEX, which trades mostly paper contracts with less than 1% resulting in physical delivery, the SGE is a physical market. When traders buy silver contracts on SGE, they receive actual metal. This means SGE prices directly reflect supply and demand for real deliverable silver. COMEX is primarily a paper market. The rest are settled in cash or rolled over. This allows COMEX prices to be driven by speculative positioning, algorithmic trading, and leveraged bets rather than physical supply and demand. This structural difference creates persistent price divergence. Shanghai premiums typically exist due to China's unique market structure. Import quotas controlled by the People's Bank of China limit silver supply. Strong domestic demand from jewelry manufacturing and industrial applications, especially solar panels, creates upward price pressure. China's 13% VAT on silver imports, currency controls on the yuan, and high transaction costs contribute to the premium. A persistent premium in Shanghai indicates strong Chinese demand or restricted supply. When the Shanghai premium widens during Western paper selling, it's a signal that the physical market may be tighter than futures prices suggest. In late December 2025, the physical silver price on the Shanghai Gold Exchange closed at $78.49 per ounce. Physical silver premiums over COMEX futures exploded to over $8 per ounce. By January 2026, Shanghai was trading silver at $120 to $130, while COMEX printed $92. That's a 40% premium. The Shanghai Futures Exchange publishes weekly warrant stock data showing the amount of silver held in approved warehouses. SHFE warehouse stocks are declining. Combined SHFE plus SGE inventory down 4.88% in the last week of February. Declining stocks with rising prices suggest strong physical drawdowns and tightening supply. Francis Hunt, a veteran trader, pointed to the persistent premium between silver priced in the West and silver priced in China. By adjusting the Shanghai futures contract from renminbi into dollars and converting kilograms into ounces, Shanghai was trading several dollars higher than its COMEX equivalent. At various points in late 2025 and early 2026, the difference amounted to 6 to 7%. In theory, such a gap invites arbitrage. Buy cheap in the West, ship east, and capture the spread. In practice, the premium exists precisely because that process is neither trivial nor free. Transportation, insurance, logistics, and scale erode the margin. The deeper truth is that Shanghai has become the center of real demand. While paper markets like COMEX dominate trading volume, persistent physical premiums in Shanghai serve as a reality check, suggesting the true cost of owning silver today is increasingly set in the East. Now, the resistance case. Because intellectual honesty is not optional when real money is at stake. Silver dropped 8% from its highs in under 2 hours. That is not a minor technical setback. That is a significant break that can extend lower if the 150 EMA on the hourly does not hold. Gap fills are real. We gapped up at the open and partially filled back. If silver cannot reclaim and hold the 150 EMA, $84.9 is the next significant level, and there is limited technical support between here and there. Western mining stocks are not following Chinese miners to the upside. Chinese miners limit up while Western miners sit flat is either a divergence about to resolve violently to the upside, or it's institutional money in Western markets telling you they're not yet convinced. The structural silver deficit, 10 consecutive monthly green closes before this week, does not guarantee short-term price support. Deficits can coexist with paper price suppression for longer than most retail participants can remain solvent holding leveraged positions. These risks are real. They deserve the same honest treatment as the bull case. And yet, China had a physical gold-buying stampede that crashed its largest e-commerce platform Monday morning. Physical investment bars are sold out at retail stores across the country. The Shanghai premium on silver held at $12 through the entire Western Slam. Physical gold in Chinese retail is trading $1,000 above Western spot because the inventory is gone. Qatar's LNG and Saudi Arabia's largest refinery are simultaneously offline. European gas prices spiked 52% in the largest move since Russia invaded Ukraine. The structural silver deficit that has been building for years has not changed because of a single session's price action. The Silver Institute projects a 67 million ounce shortfall in 2026. JP Morgan sees silver averaging $81 per ounce this year, with a physical deficit projected to reach 245 million ounces. 6 consecutive years of deficit. China implemented export restrictions January 1st, affecting 60 to 70% of global refined silver. COMEX registered inventories down 70% since 2020. LBMA vaults down 40%. Lease rates at 8%. And the unresolved question sitting over every single one of these data points is this. Does informed institutional money know something that has not appeared in the public data yet? Paper is suppressing physical reality across oil, silver, and gold simultaneously during the largest multi-front energy infrastructure attack in modern history. Those 3 things happening at the same time in the same direction, managed by the same mechanisms, is not coincidence. It is coordination. And the gap between coordinated paper suppression and accelerating physical scarcity has a historical resolution rate of exactly 100%. It always closes. The only variable is when. Bottom line, Shanghai silver held a $12 premium through an 8% Western dump. That premium survived because physical demand in Asia didn't respond to paper price manipulation in New York. China had a gold buying stampede that crashed its largest e-commerce platform. Physical investment bars sold out across retail stores. A $1,000 premium on craft gold because nothing else is available. Qatar halted LNG production. 20% of global gas supply offline. European gas prices spiked 52%. the largest move since Russia invaded Ukraine. Saudi Arabia's largest refinery shut down. The Strait of Hormuz frozen. Oil should be at $100. It's being suppressed at $70. Paper markets and physical reality are separating. The data is clear. Physical scarcity is real. Paper suppression is temporary. The gap always closes. History doesn't repeat, but it rhymes. Stay informed, verify everything, and I'll see you in the next breakdown.